Welcome to this deep dive. Today, we're cutting straight through the Q4 and full year 2025 earnings call for Vestis Corporation. That's VSTS.
Yeah, and this was not just a quarterly check-in. This was a huge one.
Absolutely. This was management rolling out a massive multi-year strategic transformation plan. If you're an experienced investor, you know Vestis is in a pivotal, really high-stakes moment.
And barely a year post-spinoff from Aramark.
Right. So our mission is to filter out the noise and figure out, is this transformation a genuine fix, or is it just a strategic reframe of some ongoing deep-seated problems?
That's the critical distinction, isn't it? I mean, Vestis has been plagued by execution issues, client attrition, heavy debt, really since its separation in 2023.
And the market sees that.
The market definitely sees that. Management projected a lot of confidence on this call, but the immediate response was, let's just say, highly cautious. You have to analyze this with a serious focus on execution risk. Promises are cheap.
And delivering $75 million in savings is not.
Not at all.
Okay, so let's unpack the results that landed. The headline numbers were mixed, which is always the most confusing kind of print.
Why?
Reported revenue came in at $712 million. That narrowly beat expectations. So far so good, right?
On the top line, maybe.
But the profitability side was rough. Non-GAAP adjusted EPS hit 3 cents. Missing the consensus of about 6 cents. I mean, they missed by half.
It's a huge miss. And that revenue beat you mentioned, that was the ultimate head fake. This is the first crucial thing you need to understand from this call.
Okay.
That $712 million figure was inflated by a massive $51.6 million benefit from, of all things, an extra operating week in the quarter.
Ah, the infamous extra week. It gets them every time.
It completely distorted the underlying trend. So when you normalize for that, you back it out, the true revenue for the quarter was closer to $660 million.
So what looked like a tiny beat was actually a 3.5% year-over-year organic revenue decline.
Exactly. And that's not a beat. That's a significant contraction. It shows the underlying business is still shrinking.
3.5% decline is a real caution flag for what should be a stable business. Where did that drop hit hardest?
It was all driven by lost business. We saw an $18.1 million decrease in their core rental revenue, and then another $5 million drop in direct sales.
So they're just not replacing the customers that are leaving?
They're not. That's huge, like $60 million annualized churn headwind in the quarter. And if you want the GAAP context, the net loss widened to $12.5 million from just $2.3 million a year ago.
Wow.
The structural issues from the spinoff are clearly getting deeper, not healing.
Okay, so seeing all this, management couldn't just manage expectations. They were pretty candid, calling FY25 a reset year. They pointed to 3 core inherited challenges. What were the, operational sins of the past regime they're trying to fix?
The CEO's diagnosis was surprisingly blunt. First, he said they prioritized sheer revenue volume without thinking enough about revenue quality.
So they were just signing any deal they could get.
Pretty much.
Yeah.
Bringing on business that was low margin, high cost to serve, and it diluted overall profitability. It's a classic services mistake.
And the second point?
Lack of focus on customer service. That's what led to the attrition. If you're losing your best, highest margin customers, it usually means you got too aggressive with pricing and you underinvested in the service to keep them happy.
They squeezed the sponge until it broke.
Exactly. And the third issue was discipline in their product mix. They were over-indexing on things like, low-margin workplace supplies, soap, paper towels.
The easy stuff to sell.
The easy stuff, right. At the expense of their core, sticky, high-margin, uniform rental business. The strategy just got fragmented. So this new transformation plan is the counter strategy to those 3 failures.
So let's get into that turnaround blueprint. It's a multi-year effort aiming for completion by 2027, but the big number, the one the market is focused on, is at least $75 million in annual cost savings by the end of fiscal 26.
And they have to spend money to save money.
Right. How much?
They estimate restructuring costs will run somewhere between $25 and $30 million. The whole plan rests on 3 pillars. Pillar 1 is commercial excellence.
Okay, what does that mean in plain English?
It means getting smart about who they serve. Customer segmentation, strategic pricing, and just being disciplined about the accounts they take on. They're explicitly targeting higher margin business.
And I thought it was interesting, they're shifting focus from just going out and getting new customers to keeping and expanding the ones they have. They're deploying these. Market development representative, MDRs.
Yeah, those are basically internal sales specialists focused only on upselling to existing customers. Management is staking their reputation on the idea that 80% of future growth will come from that existing base.
That's a huge philosophical shift.
It is. Which brings us to Pillar 2, operational excellence. This is where the real money is. Management said that about 75% of that promised $75 million in savings is going to come from fixing their unoptimized plant operations.
That number, 75%, is so revealing. If 3/4 of your savings come from fixing your operational backbone, it tells you just how neglected that part of the business was.
It implies a total lack of investment and standardization for years. They're basically admitting every laundry plant was running its own weird process. This is all about imposing standards and getting every plant to operate as efficiently as their best one.
And the third pillar is more long-term, asset and network optimization.
Right. Evaluating route efficiency, maybe consolidating some locations. But they were smart to emphasize they need to fix the processes inside the existing assets first. That's pillar 2, before they start shutting things down.
Yeah, you don't want to just merge two inefficient plants and create one big inefficient plant.
Exactly. You need a reliable engine before you start messing with the chassis.
This all sounds great on a slide, but the market is worried about execution, especially with their financial constraints. Let's talk about the balance sheet.
The balance sheet is the tight leash around this whole thing. They have $298 million in liquidity, which is fine. But the debt. Total debt is a very chunky $1.34 billion.
Okay, and that brings their leverage too.
A net leverage ratio of 4.7 times TTM covenant adjusted EBITDA.
Oof. 4.7 times is a heavy, heavy number for a company that's also trying to execute a turnaround and fighting an organic revenue decline.
It means every single dollar is under immense scrutiny. It limits their flexibility. No M&A, no big dividend changes. It puts extreme pressure on them to deliver that $75 million in savings now.
Because if they miss,
that debt becomes a huge systemic risk. The one small positive note was that Q4 did generate about $16 million in free cash flow, which was a nice improvement from Q3.
So with that debt pressure, the guidance for next year becomes the whole roadmap. How are they predicting profitability against that declining top line?
The revenue guidance is pretty sober, flat to down 2% versus the normalized FY25 number. So they're still expecting a struggle with customer churn.
No surprise there.
The real risk and the real potential reward is in the profit target. Adjusted EBITDA guidance is set for $285 to $315 million.
Okay, so if we take the midpoint, say $300 million, that's about a $40 million lift over the Q4 run rate, which was about $260 million annualized.
You got it. That $40 million lift is basically Vestis telling the market, we're going to execute a huge chunk of our $75 million savings plan in the next 12 months.
It's a bold promise.
A very bold promise. And they even gave phasing. They said Q4 2025 was the bottom. They expect Q1 2026 adjusted EBITDA to be 7 to 10% better than that Q4 number.
That first quarter number is everything. That's the first tangible proof point the market will get.
If that Q1 number hits, it's a huge signal. If it misses, the market panic will be severe.
So let's connect this back. Why is Vestis such an outlier right now? I mean, compared to its peers in the industrial sector.
The performance gap is just shocking. Vestis is down 55% year to date. The broader industrials ETF, the XLI, is up around 18%.
55%. That's purely an execution discount.
Completely. And you can see why. That revenue retention rate of 91.8%. It sounds okay, but when you see the $60 million churn headwind in one quarter, you realize how hard they have to run just to stand still.
We did see one interesting signal from the C-suite, though.
Yes, the CEO stepped up. He bought roughly 82,000 shares after the print, worth about $500,000.
Boosted his personal holdings by 15%.
It's a strong insider vote of confidence. But, when your stock is down 55%, a $500,000 buy is symbolic. But it's not enough to reverse the deep skepticism out there.
So what does this all boil down to? We're looking at a classic high-pressure margin repair balance sheet risk story.
That's the perfect way to put it. Management has defined the problems, they've outlined the solution, but the market demands proof. Concrete, visible proof, starting in Q1.
Which brings us to our speculative segment. This is where we put on our analyst hats and pitch a high-risk, high-reward trade idea just for speculative consideration. So remember, this is not financial advice.
Definitely not financial advice, merely an exercise based on the data.
Okay, so given the volatility here, our trade idea is a leveraged transformation play. What's the thesis?
The thesis is simple. The stock is currently priced for distress. I mean, it's been hammered.
Yeah.
But management has drawn a clear line in the sand with that $75 million savings target. If they execute, the upside is massive.
Right, because if they hit that first proof point, that 7 to 10% per CE EBIT lift in Q1, the execution risk immediately drops and the stock could re-rate very, very quickly.
So the action would be to consider a long position in Vestis equity, or maybe even some short-dated call options, betting specifically on that near-term success.
And this is a huge but. You cannot ignore that 4.7x leverage. Failure to hit that savings target would be catastrophic, so you have to have a hedge.
That's the key. That's the structural protection. At the same time, you'd buy long-dated put options, maybe 9 to 12 months out. This hedges against the primary risk, which is that they just fail to deliver.
So if the turnaround stalls, the high leverage and the litigation risk will crush the stock, but your puts protect you.
Exactly.
Yeah.
It lets you play the execution story while intelligently hedging the fundamental balance sheet risks.
It's a sharp way to play it. Okay, to recap this deep dive, you have to look past the reported revenue to see the underlying 3.5% organic decline.
The entire story now hinges on that $75 million transformation plan. It's all about operational rigor and getting back to their core business.
Management has set a very high hurdle for themselves. They have to show sequential margin improvement starting in Q1 against this backdrop of high leverage and customer churn.
So the core question for you to answer is this. Can this new management team successfully pivot from the old team's obsession with just revenue volume to prioritizing revenue quality and margin? You have to watch that Q1 report very, very carefully.
And a final thought for you to carry forward. The CEO said the business model itself is solid, but the processes and technology underpinning it were not. This isn't a small tweak, it is a massive internal cleanup job. So what specific measurable signs will you look for next quarter to prove this new leadership actually has the discipline the former team lacked? Consider that for your own review. We appreciate you tuning in to the deep dive.
All views expressed are solely our own and do not constitute investment advice. Please consult your financial advisor before making any investment decisions.